Hi, I'm Dave Nolan, a senior investment strategist at McKinley Wealth Services, and today I'd like to highlight our third quarter market review and investment outlook report. In our second quarter Huddle newsletter investment report entitled The Few, the Proud, the Elephants, we showed that 2/3 of the first 6 months stock market returns were driven by a few large companies referred to as the Magnificent Seven. However, in the third quarter, we began to see other stocks participate in the stock market's rise. While the S&P 500 rose 5.9% for the quarter, the equal-weighted S&P 500 index and the equal-weighted Russell 1000 rallied 9.5%. The Magnificent Seven components of the S&P 500 rose just 2.5% for the period as investors focused on those stocks that were not associated with the artificial intelligence theme that was so prevalent in the first half of the year. In fact, technology stocks, as measured by the Technology Select Sector ETF, were actually flat for the quarter. On September 18th, the Federal Reserve reduced the federal funds rate by 0.5% in order to become less restrictive in their monetary policy. As inflation continues to subside, the Fed has now turned its attention to the jobs market and their goal of a soft landing for the economy. As a result of the Fed's actions, money market fund yields have dropped, and shorter-term bond yields are now below longer-term bond yields for the first time in 2 years. With $6.5 trillion in money market fund assets outstanding, it's reasonable to expect that investors may move some of those assets to the bond market and potentially the stock market as the Fed reduces the federal funds rate further this year and into 2025. Regarding the overall investment environment, we continue to focus on the stability of the market's three-legged investment stool. These legs are inflation, interest rates, and corporate earnings, and their relative changes impact the overall health of the stock and bond markets. Looking at inflation trends in the third quarter, both the Consumer Price Index and the Federal Reserve's favorite inflation gauge, the Core Personal Consumption Expenditures, or PCE Index, reported good results. Through August, the year-over-year change in the core PCE was 2.7%, and the 3-month increase was only 2%. We continue to monitor inflation very closely as market expectations are for persistent easing in inflation trends, which then contributes to moderating interest rates and ongoing support for stock and bond prices. Regarding the interest rate outlook, the 10-year Treasury bond yields peaked in late April at 4.7% and have dropped back to 4%, helping bond prices rise and providing less competition for stocks. 2-year Treasury note yields also peaked in late April at a rate of 5% and are now yielding 4% as well. The Fed's guidance for the remainder of 2024 is another 0.5% drop in the Fed funds rate, which should bring the 2-year Treasury yield down from here. The 10-year Treasury yield may remain range-bound unless economic activity slows down markedly. With the increase in bond prices this year, we prefer to invest in bonds maturing in the 5 to 6-year range, where yields are still relatively high and downside risks are minimal. On the earnings front, Zacks Investment Research expects total S&P 500 earnings for the third quarter of 2024 to be up 4% from the same period last year on 5% higher revenues. However, recent earnings revisions for the third quarter have been negative. These negative revisions mean that the 8% estimate for calendar 2024 is solely dependent on the fourth quarter results reaching double digits. Should the fourth quarter estimates be reduced, the stock market may experience a pullback. Looking at the calendar year 2025 picture, total S&P 500 earnings are expected to grow by 15%, with projections of nearly 13% growth in 2026. Next year's earnings are also projected to be strong for small cap and international stocks. Additionally, corporate profit margins for companies remain elevated as productivity expands. The stock market will likely respond well should these estimates be maintained. Taken together, the three legs of the market's investment stool serve to support our positive thesis on the direction of stock and bond prices. Slowing inflation data and unemployment above 4% are likely to allow the Federal Reserve to cut the federal funds rate twice before year-end, with additional cuts in 2025. While the upcoming elections and global instability are certainly wild cards for the stock market, the fourth quarter is historically the best quarter for stocks. In fact, since 1950, the S&P 500 has increased by more than 4% in the last 3 months of the year, according to Dow Jones market data. Thank you for watching today, and please read our full market review and investment outlook report for greater detail on the third quarter and our forecast for the rest of 2024. Take care, and we'll see you next time.